invested in this project on Main Street, 120-134 Main Street, earlier this year. We are building 75 units there, 74 residential and 1 retail. This project is an interesting project because it was a mid-construction buy-in. We expect to have this project complete within the next 9 to 12 months. And the current NOI looks like it should be right around $2 million, bringing the value of this project to $37 million. The total cap stack looks like about $2 million in equity and around $18 million in debt. So all in, we're gonna be in for $20 million with a value of over $37 million when complete. The projected exit strategy on this particular transaction is a refinance. As we see rates are already starting to drop, we expect a 75% loan to value on the appraised value. That will get us our equity back with a great amount of upside, as well as pay off the construction loan. A lot of the investors that came into this particular project were looking for tax advantages as well as having great ROI on their investment. Since this is a fairly large project, it's going to have a pretty big depreciation schedule, especially the first year. So our exit strategy is to refinance, have our investors get their money back, and they're going to make roughly about a 50 to 60% cash on cash return on their initial investment. This will allow them obviously to reinvest in other projects that we bring to the market at the time, but more importantly for the investor, it provides them with tax advantages depending on their current situation. So the underwriting on this particular deal was a little different than we typically underwrite most of our deals. Most of our deals, we come in at the beginning, so we know we have our sources and uses. We look at the project, we look at the valuation differently than this particular. This was a little harder to gauge because we had to actually look at the current construction loan, where it was at, look at the inspection reports that had come through already, kind of understand where the developer was in terms of the runway for the project, in terms of timeline, and if that was matching the current loan that they had with the project. So we did all that due diligence. We had to also get it appraised mid-construction, which we typically don't do halfway through a project, and verify the construction schedule going forward. It was a tricky time as well because we're hearing all these reports of interest rates coming down, and in order to project this out the right way, we were kind of looking at it, all right, how are we, what type of loan are we gonna get on this? Are we gonna get a 65% loan to value, a 70, a 75, an 80? We really had to forecast that out and be conservative on our projections. We had to value the equity, kind of valuing it, not really looking at, all right, this was the buy-in price, this is how much the developer has out already. It was more so, okay, what are we valuing this particular project at? How much equity is in there? And go reverse. We were able to do that successfully, get a good valuation for us, get a valuation that the developer was happy with, syndicate and raise the funds, and now we are waiting for completion, which we should have sometime next year in 2025.